Your number one job as a trader is to be where you're supposed to be when you're supposed to be there. Your job is to trade volatility. That's how, on the intraday time frame, day trading, that's how you make money. You need to be in the markets that are in play. If they are not in play and they're not moving, don't be there. This week, we're going to touch upon the markets that are actually moving, where you should be. We're going to touch upon silver. We're going to touch upon gold. We're going to touch upon platinum, oil, natural gas, and this week we're going to be focusing a little bit on cocoa. All right, so silver. We've been concentrating on the monthly chart in order to figure out where this sucker could be going. It has hit every single target that we laid out. These horizontal lines have not changed. So you had your July 2011 highs, we took that out. Your next stop was September 2011 highs, we took that out. Our next stop were the August 2011 highs. We've taken that out. Now, we've already come to the May of 2011 highs. Going back at 48 spot 190, we took that out. We made a high this month, or so far this month, we did on Friday, of 48 spot 325. We are now in a way overbought market. Now, one thing to point out, if you look at this, and this is a monthly chart, we're going to just focus here. You'll notice the pattern. Take a look what happened here in the run up into 2011. Look at 2010, we were dancing, 2010 consolidated, and then we took off. Then obviously we backed off hard, did nothing for many years. Then all of a sudden woke up a little bit, got a little choppy, and now all of a sudden we've taken off again. It's sort of the same quasi-ish pattern, just for information purposes only. Guys who trade metals are having a banner year. Some of these guys in metals are probably having a career year, honestly. This is the best trading in metals that it's been in 14, 15 years. For most of the past couple of years, metals have been basically, to a large extent, dead money from a trading perspective. It's just they have not been moving. This has been literally a career year for guys in the metal space. People who are exclusive to metals are literally having career years. Our expectation is that when end of year comes, people who are trading in the metal space specifically are going to get insane bonuses. Again, career bonuses, because this has been literally a banner year for metals. So right now, what do you do with silver? So let's go down to a little bit smaller now so we can just get an idea of what can happen now. So when we look at it, the weekly, you can see it's pretty much a free train to the upside on the weekly. Daily basically looks like the same thing. You did have a little bit of shake the tree type of action on Thursday. Friday, we just recovered. We took our Wednesday and Thursday's highs and we closed above them. So the market is looking really good. However, after a run like this, you need to be a little bit more careful. That does not mean short it max. That's not what it means. What it means is you do need to be careful, because right now up here, you're starting to chase. So you have to be relatively cautious. I would say if you're going to try and initiate new positions, you're going to probably have to do it on the smaller side, because you've missed the run. Honestly, you've missed it. Can it keep going? Obviously, it could keep going. Our next spot would be going up to here, which would be on the monthly would be the April 2011 highs, which are at 49,820. And then you have the nice round number at $50, which it may get there. With that being said, at this point, you really need to be a little bit more on the cautious side. This has been a runaway freight train. The reason why we say do not step in front to short this unless you have a really good reason and you really understand and really know what you're doing is because you're basically picking up pennies in front of a freight train. So you have to be really careful here. Initiating longs, again, is also hard because we've had this massive run up. It doesn't take a degree in rocket science to see how this thing has been moving. Like we said, you've kind of missed it. So you really have to pick your spots very carefully. And if you're going to figure out a way to short this, be very careful. Commodities differ from stocks. They don't revert to the mean, meaning whether they go, they just go. Eventually they find their home and they'll revert and then they'll kind of chill out and relax. But for right now, it's just going. All right. So let's touch upon gold. Gold was signed on the monthly. Our expectation is a push to 4,000. We don't believe that the market is going to stay there. We believe that the market is going to get to 4,000, maybe poke its head above it, maybe get to 41, 42. We ultimately believe the market's going to trade somewhere between 3,650 and 3,800 by the end of the year. That's where we think it's going to go. Right now, again, like silver, these are massive moves. Gold has not been this overbought going back to, I think, 1980. So you really have to be careful trying to initiate new positions. You'll always hear people who are the gold bugs always saying, just buy it. When you're trading, you don't have that luxury. If you buy wrong or you buy early, it doesn't matter. You could get hurt. So you really have to be very careful. Gold in general is very sweepy. The book can get thin at times. And when it really starts to pick up some speed, it sweeps the books. You really have to be careful with it. Again, just like silver, you really should not be looking to short this thing. It's a runaway freight train. We said this before. We'll say it again. It bears repeating. Why would you step on the tracks and try and short this thing when it's not telling you to short it yet? So just be very careful. Again, with initiating longs, it's something you need to be cognizant of that you're chasing. So you really have to be careful. One thing we've been talking about within our group, and it's something that we feel that should be brought out to the overall general public. One thing to watch out for when you're trading both the GC, the gold futures and silver futures, the GC, the SI, or if you're trading the SIL, whichever instrument you're trading, even though the market's technically open at 820, 825 respectively, you do need to be aware of what happens at the 930 bell when the GLD and the SLV both open. Those ETFs, when they open, they tend to play some funky tricks in the futures. So you have a lot of equity traders that are starting to buy gold and silver ETFs, GLD, SLV, whatever else they're buying. So it does have an effect on the futures markets because these instruments do hold futures. They don't necessarily hold physical gold. They're more tied to futures. So you have to be aware of it. We've been seeing this repeatable pattern over the past couple of weeks. Specifically, we saw it over the past week for sure. We believe it's going to continue this way, where when the market's open at 820 and 825, never mind any data. We're going to leave data out of the way for a minute. The markets tend to be choppy and barcodey. That's their complexion. And then once 930 happens, usually that's when you're starting to get your moves pretty much right at the 930 bell, 931, 932. And that's a direct result of the GLD and SLV and equity traders buying it. So be aware of it. That doesn't mean you should be, however you trade, do what you have to do. But just be cognizant of the fact that at 930, when these ETFs open, the gold and silver world changes. Okay. Let's move on to platinum. Okay. With platinum, we're starting on the monthly chart. One thing we want to point out before we start platinum, silver, gold, platinum are all doing the same thing. They carry one specific trait. They are all making new 9, 20, and 45-day highs. All of them, which means that there is a lot of momentum and a lot of power behind this. Okay. So just be very, very aware of what you're in, why you're in it, why you have the direction that you've picked. Be very careful, whether long or short, where some of these things, gold, silver specifically, are nosebleed territories. Okay. Platinum, we took out the 2014 highs. We've already did that last month. Obviously, it's blasted off. We got the 1642. We believe this is the February 2013 highs. We believe these are going to get taken out. That's at 1744.5. We believe that's going to happen. We think it's going to happen this month, probably within the next week or two. There's a lot of power in platinum right now. Your next spot after that is going to be the August 2011 high, which is 1918 spot 5. We think ultimately the market may try to get there. It might have a little bit of a struggle, and we don't think this 1918 is going to really hold. If it gets there, we think it's just going to get to 2000. We just think ultimately that's where it's going to go. We think it's going to overshoot. However, you do have to contend with this 1750-ish area first, which again brings you back to the February 2013 highs. So you can see they were basically doing nothing. They were dead money for years, years and years. Yeah, a little bit of spikes here and there, but now all of a sudden they're just rocketing. So just be aware of it. For metals traders, a lot of them are having literally career years. Bonuses are going to be insane. You're going to see it in the news. Metal guys having their best year in decades. Metals guys are doing very well. And congratulations to all of them, because people who specialize in metals have had to sit through many years of pain and many years of watching their colleagues and their peers in different asset classes do extremely well, whereas metal guys weren't doing as well. Now it's their time, so to speak, to shine. So congratulations to all of them. Let's just look quickly at a parabolic move. These are massive. These are monster moves. Now you could say when you see a parabolic move like this, okay, I'm going to get ready to short it. The problem is, what's your reference? And you could get hurt in this thing very quickly. Specifically with platinum, the book is thin. It doesn't do the volume that gold and silver does. It doesn't have the interest that gold and silver does. To a large extent, it's a wider spread. It could be 3, 4, 5, 6, 7 ticks wide. If some kind of wacky news happens and it has some kind of weird move, it could jump over your stops. And with a wide spread, you could really get hurt if you're not careful. So this is not something you really want to size into from a risk perspective. You don't really care about what happens on the upside. The upside takes care of itself. You really need to focus more on the downside, protecting yourself on the downside. And with some of these things, platinum, gasoline, heating oil, one of those instruments that are a little bit thinner and the books are a little bit thinner and the spreads are a little bit wide, any kind of weird move, and let's say, for example, in platinum, you were looking to use, I don't know, a $4 stop. Let's just say for argument's sake, you could get clipped for $6 in some kind of wacky move, which would mean $2 worth of slippage. It could happen. So just be careful, be aware of it, understand what you're in, be careful with size. This is not something you really want to size into because, again, the slippage aspect of it, if you put on a big position, and let's just say a big position in platinum could be a 5 lot or a 10 lot would be a ginormous position. When you're thinking about risk, when you're dealing with a 5 and a 10 lot in an instrument like this, the book is so thin, you're spraying the market or with market orders on your stops. You could get filled $2, $3 away from what you originally thought your risk was going to be. So you really have to be really, really careful with it, like really careful. Okay. All right. Let's get into some oil and natural gas, and then we're going to get into cocoa, and then we're going to wrap it up. All right. Oil. We've been concentrating on this $62 to $64 range where the market's basically been holding. It's been poking its head out of it, coming back into it, poking out, coming back in, poking out, coming back in. Now it's broken to the downside. There were rumors circulating that the planned OPEC meeting for this Sunday on October 5th, there was rumors circulating that there was going to be an exorbitant amount of production coming on. OPEC quickly put the kibosh on that and said, no, it's not true. The reality is that no matter what they announce on Sunday, it really doesn't matter because the truth of the matter is outside of a couple of countries, they aren't meeting their production goals anyway. So a lot of it is just bluster. We're going to raise production. We're going to put more oil on the market. The reality is that a lot of these countries are not able to even hit their production quotas to begin with. So a lot of it is just noise. We basically believe it's going to be a big fat nothing burger. The market knows that they're raising production levels. The market knows that more oil is coming. Quite frankly, at this point, I don't think the market cares. We are of the opinion that the market is just going to do what it's going to do. It doesn't really care one way or the other. As long as they're not taking barrels offline, we don't believe that it's going to be too much of a issue for oil. We do believe ultimately oil will have a 5 in front of it. We don't know how long it will stay with a 5 in front of it. We don't believe this is going to be the start of a big move to the downside. Even if we do get to the mid 5s, we think we'll stay there for a little bit of time and then bounce back up. So we're looking just ranging. We do not believe that this is the start. Any announcement will be the start of any new moves. We don't believe that it's going to get more. It probably lands somewhere in the mid 5s and finds its home there and maybe bounces around between 55, 54-ish and 60, maybe even 62 on the upside. The one caveat is that if for whatever reason Russian sanctions are slapped on, and whether from the US and the EU, that could create a little bit of a supply issue where the market now needs to adjust from barrels coming off. Always keep in mind, Russia is the plus of OPEC plus. OPEC, to a large extent, we always know it's the cartel of countries, but it's really pretty much Saudi Arabia. The plus is Russia. So really, OPEC plus is the Saudis and the Russians. The two main players are the Russians and the Saudis in the context of OPEC plus. So your three main players for oil production are the US, the Saudis, and the Russians. So you do have to be cognizant of that. If there is some kind of sanction, there could be a spike in oil. Granted, we don't think it's going to be a huge spike. With all the fear of Russian sanctions, oil barely could get above 66. It got there and then basically got rejected almost instantaneously. So we think that the market is range bound. It is tradable. It is definitely tradable. Some of the volatility is a little bit more deceptive recently. It's because the volatility isn't really there. It's not really moving around. It's very rangy. We believe that even if it breaks 60, which it may ultimately do, we believe on the first test of 60, it probably bounces back up to 62, 63, try and figure out what to do, and then maybe roll over again, or just stay with the same pattern of staying in the $62 to $64 range. But again, we want to stress that it is tradable. There are trades that you can have here. There is money to be made here now. It is not so much a snooze fest as it was, but you do have to be cognizant of the fact that you may not get the amount of juice that you're looking for, because again, there's a lot of headlines coming out, and with the whole Russian sanctions looming over the market, hope that could keep a floor under prices. But one thing we do want to stress though, demand, as we said, it's been a recurring thing that we've been going over for weeks now and months. The demand aspect of it is not there. It's clear. Rig count this week, it was unchanged, which means U.S. producers are not adding more rigs. So the demand is not there like everyone would like to believe that it is. Therefore, the oil price in general is very muted because of that fact. Okay, so that's oil. Let's go to natural gas. What we did say, and we've been speaking about this also for weeks, we believed that this low in August was secure. We did not believe that this was going to get taken out. The low here was 622. We felt this was secure. We felt the market had a little bit of a pop, hung in, came in a little bit. Then we had this gap. And now the market got to our initial target was $3.50. We got to $3.50. Now we'll see where we go from here. Natural gas is very in play now. It's moving around. There's ranges. You can make some money in it. We think that for now, the market's probably going to hang out between the $3.10-ish area and $3.50. We think that changes as we get closer to the end of the calendar month, when weather starts to become a factor, it starts to get colder in the U.S. Then we believe that the market probably starts to move to its next area, which would be $3.50 to $4. So the market is definitely now waking up. We think you should have it on your radar. We think that it's a worthwhile place to be. So to recap, before we move on to cocoa, the 5 places we believe are the best right now in the CME group of markets would be gold, silver, platinum, crude, and natural gas. All right, let's move on to cocoa and then we'll wrap it up. So you're going to ask yourselves, we've been talking about coffee the past couple of weeks. Why are we going to cocoa and ignoring coffee? The short answer is cocoa is in play. Coffee is not as in play as it once was. It's kind of been a little bit more subdued. Cocoa is really the one that we believe now is starting to become a little bit more in play. It was in play on the upside. It blew a lot of people out. And then we've been taking out levels slowly. The first level we were looking at was this low going back to March of 2025. We took that out. Then we were looking at these lows over here going back to September of 24. We took that out. We had a low here of October of 24. We took that out. And that's when all the craziness was really going on in cocoa. You can Google it and see what was driving the prices. At the time, it became so thin and so wild and so crazy. These are weekly bars, but on a daily basis, cocoa trades at $10 a tick. There were days where if you had on a one lot, from high to low, the move was on par from a dollar perspective in the $17,000, $18,000 range on a one. Yes, on a one lot at $10 a tick, there were days where the market moved the equivalent on a dollar value of about $17,000. The market was very, very crazy. With that being said, it blew a lot of people out of the market. A lot of funds had to get out because you just could not manage, and you could not control risk. Let's go to a daily chart just to look at it. You can see that the trend started basically here around the mid-August, and it's basically been down the entire time. Now, obviously, we're starting to pick up a little bit more speed. We picked up a little bit more speed this week. Levels that we're watching, we're not going to go to a monthly. We could look at the monthly also. The monthly is not really going to give you much. So levels that we're watching, we're looking in towards this low over here on 5,300 roughly. Then we think the market maybe gets back down to these 23, 24 highs at 4,300. We think the market may get there. So those are the markets that we're focused on. We believe those will offer you the best opportunities and the best places to be and give you the most opportunity. We also believe that because of the heightened volatility, the market is a little bit more forgiving. So if you do make a mistake, you can get out of it. So those are characteristics that you want to look for. You want to find high volatility where things are moving around and it doesn't really take you a lot to make some money. But above all else, always manage your risk, know why you're getting into something. And above all else, know when and where and why you're getting out if you're wrong. You must know where you're wrong and why you're getting out there. But the most important thing is just on an intraday time frame, make sure that you get your direction correct. Intraday, more than swing and investment, you must get direction right. If you get direction wrong, you will get hurt. Thanks for watching, and we'll see you on the next one.